everybody, welcome back to my channel. My name is Jake, and today I want to be talking about some stocks that have a 10% dividend yield. Now, I just made a video on Friday about safe stocks that have a 5% dividend yield, but now I want to talk about some little bit riskier ones that I'm not saying you should invest in or that you shouldn't, but I invest in them and I know they're a little bit more on the risky side, but I like to diversify with some safety and some risk. So with that being said, guys, we'll get right into this. But if you're new here, again, my name is Jake. I like to post on Mondays and Fridays. If you wouldn't mind liking this video and subscribing, you get some more content from me, and then it'll really help me out as well, and I'd greatly appreciate it. I appreciate everybody who shows up here to hang out with me for a little bit every single day that I post. So thank you guys. All right, but with that being said, let's get into this. All right, so next up here, guys, we have Exxon Mobil, and I can already hear some people being frustrated about this one because I know a lot of people do not like Exxon Mobil as a stock right now because their dividend is so high and they are in the oil biz, which is kind of tanking at the moment, but we'll get into that here in a bit. I have 7 of these at 2.06% of my portfolio. I am down 35.01, so 12%, a little over 12%. Again, these guys handle everything from A to Z with oil. They pump it out of the ground, they develop it, and then they distribute the oil. So they have everything under their control, along with chemicals and everything. Anything to do with the oil, these guys have their fingers in it. We'll go down here. I have received a dividend from these guys because I have owned them for a while. So they pay 87 cents per share. At the time I had 4, so I got paid $3.48. If we go to track your dividend here, you'll see on the 12th they were at 34.63, a forward dividend of 10.05, annual payout of $3.48, and a payout ratio of 134.57%. Their PE is 13.39, and their dividend history. So this is why Exxon Mobil gets a lot of flack. Their dividend is extremely high for their price, and it has been growing consecutively for 18 years. And they say they can continue this, but I've also heard speculation that they could also cut their dividend in half just to pocket that money and use it for development. And I don't think that is a necessarily bad idea. Their dividend is already so high, it wouldn't really matter to me if they cut it, if it meant they can continue to grow as a company and diversify, maybe into more green energy, perhaps. But that's just speculation on my part. So their dividend safety score is a 43. Again, a little risky, on the riskier side, but that's because their payout ratio is in danger because it's so high. Their earnings per share, it has negative growth, but everything else is fair and good for Exxon Mobil. So next up here, guys, we have Pembina, if I am pronouncing that right. I have 2 shares of these and they are 0.37% of my portfolio. I have a total return of negative $4.98 or 10%. And what Pembina is they are in the energy sector from Canada, and they produce pipelines for crude oil. They also help with storage, fracking sand, things of that nature. I haven't gotten paid a dividend from these guys yet, but if we go over to track my dividends, you can see here, again, these stocks are going to be more on the risky side, so be wary of that. So this was updated October 12th. They finished at 22.06. They have a trailing dividend of 12.06%, annual payout of $2.66, and a payout ratio of 82.7. Their PE is 6.86. You see their dividend history is kind of all over the place. 2018, they dropped it down to 1 cent, and it has 0 years of consecutive growth. Just keep that stuff in mind when you look up these companies, guys. But if we come over here, you can see that their dividend safety score is a 35. And the main reason being is they have no consecutive growth. Everything else is very good, fair, good, as you can see, and high growth, but they need that consistent growth to get a higher score. So this is on the less risky side, but we'll get into more risky ones here as we go on. All right, so let's get away from oil for a second here, and we'll go to AG&C. If you guys look up dividend paying companies, you'll probably see these guys pop up quite a bit, especially on YouTube. They do pay monthly, so that is quite nice. I own 11 shares of them with the average price of $13.47. They finished their day at $14.11. They are 1.32% of my portfolio. I am up $7.06 or 4.77%. So again, like I said, agency, they're a REIT, so they invest in real estate of all different kinds, U.S. government agencies, nationally backed mortgages, and things of that nature. As you can see, I have gotten paid on October 9th, 11 shares at 12 cents a piece for $1.32. And then if we go over to track your dividends, you will see they on the 12th finished at 14.18, trailing dividend yield of 12.69%, annual payout of $1.80, and a payout ratio of 141.65%. Their PE is 12.22, and their dividend history, it has been declining, so their consecutive dividend growth is 0. But it still pays quite a high dividend, especially for that monthly. So then again, we go over to their dividend safety. They are at a 10. It's because their payout ratio is dangerous because it is so high. Consecutive dividend growth, there is none. And then their dividend growth rate is actually negative. So again, this is extremely speculative buy on my part. But as you see, Rona kind of killed this stock for a minute. But it is on a slow uptick, and right before the Roni hit, it was at 1962. So it is quite speculative, and REITs got hit quite hard right after Roni hit. Next up here, guys, we have Gladstone Investment. They finished their day at $9.07. I have them at an average cost of $9.79. I own 19 of them. They are 1.46% of my portfolio. I am down $13.68 or 7.36%. And what these guys do is essentially they buy debt from established businesses, and then they turn that cash flow into a dividend for their investors. As you can see down here, I did get paid on October 1st. These guys pay monthly, 7 cents a share for $1.33 because I own 19 of them. Now, if we go over to track your dividends, you'll see that they have, on the 12th, they finished at $9.015. Their trailing dividend is 13.58 for an annual payout of $1.22. And their payout ratio is 1,329.42 or 42%, sorry. Their PE is 97.91. So extremely risky in my opinion, but the dividend history is consecutive all the way back to 2015. They do have a 0-year dividend growth, but it has been holding steady at 7 cents for until just right before 2018, so 2017 here. But if we go over to their safety score, you can see they're at a 5. It's because they have no consecutive growth, like I said. Their payout ratio is danger, of course, and their earnings per share is negative. Again, a speculative play on my part here. Now, before we get into the last one, guys, if you wouldn't mind checking the description below, you can get 1 free stock with Robinhood. If you sign up using my link, we both get 1. If you would like, you can also check out Yada, which I'm going to do a product review on. You can get 100 free tickets through them. They are a savings account that is a prize-based savings account. It's pretty cool. Check it out. And then also, you can get $5 in an Acorn account if you use my link as well. We both get $5. I'm doing a series where I put $5 a day into that, and I donate half that to charity at the end of 52 weeks. Awesome, guys. Thank you. All right, let's continue. And then finally, guys, we have SCM or Stellus Capital Investment. This is the most speculative that I get, and you'll see why here in a bit. I have them, they finished their day at $8.68. I have them at $8.22. I have 12 of them, 4.88% of my portfolio. I have a total return of $5.47 or 5.54%. So they're a closed-end, non-diversified management investment company. Its investment objective is just to maximize total returns for their stockholders, essentially. And as you go down here, October 1st, I got paid from these guys 12 shares at 25 cents a share for a total of $3. Now, if we go back up to track your dividends, you'll see why these guys are quite risky. They finished October 12th at $8.68, forward dividend yield of 34.52%, annual payout of $3, and payout ratio of 207.38%. Their PE is 6. Their dividend history, you can see here throughout 2019 into 2020, pretty steady at 11 cents, and then bam, shot up to 25 cents. They have a consecutive growth of 6 years, but it is very minor. And then you go over to their dividend safety is at a 28%. Their payout ratio, danger, and their dividend is negative growth. But the forward dividend yield is at 34.52%, which is very unsustainable in my opinion. So I don't expect this to stay this high for very long at all. All right, and there you have it. Those are some of my riskiest plays, guys. I hope you gained a little bit off that. I know they're quite risky and kind of gambly in some little aspects of it, but I like to try to balance my risk with some safety, and I figured you guys might want to see that side of my investments. Again, I try to only invest in companies that pay dividends, and I have no shame of getting rid of companies that stop paying their dividends as well. I try not to lose them at a loss, but I have done that in the past, I won't lie. Again, guys, if you got anything out of this, I would appreciate a like, subscribe if you do not mind, and also leave a comment down below if you have a risky one that you kind of are like worried about a little bit, but you like to still invest in it just for the thrill of it, right? All right, guys, with that being said, I hope you all are staying safe out there, taking it easy, and sticking to your strategies. All right, with that being said, peace.